Hello and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sale of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling a business. I'm pleased today to have a guest speaker, Blake Christian. And Blake is a national expert on Auses, and he's going to tell you what Auses are. I'm pleased to have you here today with us, Blake.
Honored to be here, Rick. Thank you.
Tell us a little bit about yourself, and then tell us about opportunity zones.
So I've been a CPA for 43 years, started my career at KPMG in Los Angeles. I've been out in Utah for about 10 years, and we have an office in Park City and a small office in Salt Lake City. We have 13 offices, total head count of about 750, which makes us a top 30 CPA firm in the country. I spend probably 80% of my time the last few years on opportunity zones. We've set up over 200 qualified opportunity funds, and then an equal number, actually more, qualified opportunity zone businesses. And as we'll get into, the qualified opportunity zone business is where the action is. It's where either your real estate development project is or where your operating business is. So you can actually stuff an operating business into an opportunity zone fund.
Interesting. And it looks like you've done over 125 of these in your career.
Right. Of the fund, it's actually larger now. But the actual funds, we're probably close to 200. And then each opportunity zone fund has at least one qualified opportunity zone business. Many of them have multiple businesses in them.
Gotcha. So tell us a little bit about HCVT.
Yeah, so HCVT, again, top 30 firm. We have 13 offices. We're headquartered in West Los Angeles. 9 of our offices are in California. And then we have Park City, Salt Lake, Phoenix, Arizona, and Fort Worth, Texas. In addition to my Oz practice, I do high-level tax planning for individuals and corporations. We're a full-service firm. We do audits. We have a very large 401k audit practice, and we do business management and consulting. Being in West LA, we have a lot of people in the movie business, more often the people that are behind the camera instead of in front of the camera, the screenwriters and producers and things, and some musicians. So it's kind of an interesting practice.
Interesting. So people, if they're looking for tax professionals or audit or accounting work, they can reach out to you, and we'll share your credentials at the end of the podcast as well. So that's good to know. You don't just do opportunity zones.
Right. Here's some of our awards, but we can get into the meat of it if you'd like.
Let's go ahead and learn about how opportunity zones started.
And so it was part of the Trump 2017 Tax Act, Tax and Job Act, as you'll recall. And interestingly, or not surprisingly, President Trump has taken all the credit for the Opportunity Zone program, but to give credit where credit is due, it was actually the Obama administration that started the process. It just got passed during the Trump administration. So Sean Parker, who at a very young age started Napster and was an early investor in Facebook, all his billionaire friends, when they would get together, they would talk about how frustrating it was that they had this huge concentration of wealth, often in publicly traded stocks. Sometimes it was real estate, other assets, and how there was no incentive for them to liquidate those. They could get loans on them, and they would hold them, until they died, and then get a step up in basis. And so, the combination of that problem, along with the problem, economic development people had done these mini studies that when economic infusions went into different cities and things, almost all of it was either into the greater New York City area, greater Los Angeles area, and Chicago. It was pretty limited where the money went. And so he combined these economic development studies and seeing some of those shortfalls in these poverty-stricken neighborhoods and said, hey, what if we encouraged people to liquidate these big positions, either in publicly traded stock, real estate, other assets, could be artwork, and incentivize them to invest in these communities? Wouldn't that be a great program? And I think it's a brilliantly designed program, and that's exactly what they did. They said, look, we'll get into more of the details, but sell your stock, create a gain. We'll let you defer the gain, and if you invest in these communities and you hold those investments for at least 10 years, all the appreciation that you gained on that investment will escape taxation on the federal side. And all but about 6 states followed suit. And so it's both a federal exclusion and a state exclusion. The big states that didn't adopt it, California, disappointingly, Arkansas, North Carolina, Massachusetts, and New York has kind of dialed it back a little bit. So, but most other states have adopted it.
So let me get this straight. So these people can sell their stock, sell their assets, and instead of paying the tax at the liquidity event, they get to defer the tax. And if they keep their investment for 10 years, they can potentially eliminate that capital gain.
That's absolutely right. You defer the tax under the current code until December 31st, 2026. And so early adopters, were deferring gains for more than 7 years. Now you can still defer it for 4 years. So essentially you're getting an interest-free loan for 4 years. And in today's interest rate environment, that's a huge bargain. You can invest that money, compound your interest on a much bigger investment than if you had paid tax up front.
Wow. I absolutely love this notion. And I didn't share this with you, Blake, but I'm from a very small town in southeastern Utah. And you go into these areas. In fact, I was down in Green River, which is a small town just north of Moab. And you go down Main Street, and the bank, the nicest building in the whole town is a bank, and it's made out of granite, and it's solid, but it's boarded up. And you see these areas, these communities that are a little more rural, but wages are low, jobs are nearly non-existent, and people are just kind of scratching out an existence there. And I love to see these. I want to call it smart money or smart dollars. I love to see the smart dollars coming into the community, boosting these more rural areas up and helping build them economically. And then they have money for schools. They have money for social programs. They have money for their roads and their streets and the things which these people need. So I love this idea. And these opportunity zones are one of the very few, I don't want to call them loopholes, but it kind of is, right?
Right. And so there's 8,700 census tracts, and census tracts are, they're not defined by zip code or anything. They're these odd shaped areas, and in rural areas they can be, tens of square miles. In urban areas, they're usually just a couple of city blocks. Usually it's comprised of at least 10,000 people, residents there. Again, it's across the country, and they're not all each governor got to pick the census tracts, and they had to narrow down. They had about 5-to-1 ratio of what they could pick. And so they picked those, census tracts that they felt, would have the best chance of bouncing back. A lot of these areas are pretty nice. Down in Salt Lake, there's some great ones. And it's in proportion to population of the state. So California has about 880 census tracts. Utah only has about 18, but they're still, pretty impactful, and people are investing. Provo is generally one of the top 5 rated census tracts, and actually I have my own Oz fund located there.
Interesting. So the census tracts, where can people find them for people that are on the podcast that don't have the video?
Yeah, so there's 2 places. Opportunity DB database, opportunitydatabase.com/map, or Novogradac. I won't try and spell it, but just Google it and it'll narrow it down for you. But Novogradac is kind of the 800-pound gorilla in the Oz arena, and they do a great job of getting information out to the public on this program. And so they have a very interactive database, but you can get to it either way, or contact me and I can give you the link.
Got it. And so Oz stands for Opportunity Zone, right?
That's correct. Again, a bipartisan program, and it's both Republicans and Democrats for the most part really like it. There's some detractors, now that the program's underway, but for the most part, most people are pretty big fans of it.
Yeah, I love it. I had invested in a bunch of, we had 152 units out in Ohio, and sadly they were outside of the opportunity zone by one street. They were across the street from us. I wish you could have moved it just a little bit.
Right.
So how does it work? How does the money work?
Yeah. So, and just before we jump in there, again, Novogradac, who tracks this, there's been $34 billion of equity infused as of December 31st into Opportunity Zone funds, and $10 billion of that was raised in calendar 2022 alone. So there's still, very strong momentum, and people are really liking the program. So again, there's really 3 baskets of potential benefit. The first one is the temporary deferral. So you sell your, family business today, you sell a piece of real estate, you could sell your home and you have more than a $500,000 gain. That extra gain you could roll into an Oz fund, Bitcoin, stock market gains, artwork, collector cars. It's pretty unlimited. The first step is you sell that asset, and generally you have 180 days. It's kind of like a 1031 exchange. You have 180 days at a minimum to roll that gain into an Oz fund. Now that could be what we call a public Oz fund that, is getting public money, or you can set up your own Oz fund, what we call a captive Oz fund. And about 90% of my clients are captive Oz funds, where wealthy people have a big gain, kind of a one-time event. They set up their own fund and they control everything. They either go out and do real estate deals or they start a new business. So that's the first one, and that's what gets most people's attention. They have this massive gain, and they go, geez, I don't know what I'm going to do with the money, but I don't want to pay tax right now.
Yeah, I was involved in a sale of a trucking company over in Colorado years ago, and it was about an $18 million transaction. And when the owner had been there for years, he started with one truck, and he was an oil field guy, kind of a blue collar type guy, type of guy that I really like. And you should have heard the words come out of his mouth when he realized he was going to put a third of the money to Uncle Sam. Right. And he was dying. Oh, he was so angry. And And a lot of these business owners feel that same way. You know, they're looking at this liquidity event. They've worked and sacrificed everything to build their business. And then now it's time to cash in on that. We have a liquidity event, and, you know, Uncle Sam has their hand out for 30 or 40% of it. And so, you know, this is a great vehicle, and we're so pleased to learn about this. One thing I think the listeners need to know is it's for capital gains only. Ordinary income, there's still a tax due on the ordinary income part of the sale. Is that right?
Yeah, excellent point, Rick. Glad you brought that up. So, you know, depreciation recapture on tangible personality, which is our Internal Revenue Code section 1245, is not eligible for this. But 1250, which is the shell of a building, that, even though it's taxed at a higher rate and it doesn't always look like capital gains, technically it's treated as capital gain, and that can be rolled over. So, and that's very important when somebody's selling a building. So you can put more gain than a lot of people think. So that's the first leg of this three-legged stool, is the temporary deferral. The step up in basis, that actually has expired at the moment. There was a 5, 10, or 15% what we call basis bump, where if you had $1 million gain and you deferred it until 2026, if you had held that Oz investment for 7 years by that time, you got a 15% haircut on how much gain. So you'd only report 850,000 gain. Or if you held it for 5 years, you'd only report 90% or $900,000 gain, and so on. There is legislation that we'll get into in a second that the 10 and the 5% may come back if you hold it between 5 and 6 years. By the time the program expires, they might push out that deferral period from 2026 to 2028. There's a bipartisan bill out there, but it's been stalled in Congress because of dysfunctionality of Congress right now. And the step up in basis, to tell you the truth, is the least valuable of these three, because if you have a 20% capital gain and you got a 10% basis adjustment, it's only 2% additional yield on the whole investment over a 10-year period. So it's not a big deal. But the big one, the final leg of the stool, is the permanent exclusion. That's the step up in basis. So in my example, you rolled $1 million. Yeah, you pay tax in 2027 because it was deferred till 2026. And now that $1 million, let's say, is worth $3 million 10 years from now. The $2 million appreciation during that 10-year period escapes federal taxation completely. Utah, 100% exclusion, and most other states other than those that I mentioned. And if it's a real estate deal, or if, let's say, it was solar, all the depreciation you claim goes poof along with the capital gain, because you basically, it's like a step up on death. Everything gets stepped up to fair market value the day before you sell it if you meet the 10-year holding requirement. So it's extremely valuable program. There's really, other than 1031, there's nothing else like it out there. But in my 43 years of practice, this is, the silver bullet in tax planning if you meet the requirements.
Wow. So for someone who had sold their business, say, a couple of months ago, because I'll get these calls from time to time, Blake, where they're like, you know what, I sold my business, we've funded and everything, what do I do? So they have 180 days after the sale to do this. So we can save some of these people from huge tax burden even after they've already sold, as long as it's within that window, correct?
Correct. And it even gets better, that if your gain comes through on a K1, and about 80% of the fact patterns that we look at, somebody was holding that investment through a partnership, an S corp, or a trust, a regarded trust. And so if the gain comes through on a K1, your 180-day clock doesn't start ticking until as late as March 15th of the year following the sale. So if I sold my business, which is held in an S corp right now, and I have a large gain, my 180 days does not start until March 15th, 2024, because that's the first day that I would get a K1, or that's the deadline, original deadline for a K1 to report that 2023 gain. So it's a very liberal rules. I wouldn't have to make my investment until September of 2024. So there's a whole lot of people out there, if you're looking at on an extended return, you've been told you have to pay a bunch of tax on a 2022 gain, and that came through on a K1, we can still set you up an Oz fund, and you can roll all or a portion of that gain into that Oz fund.
Awesome. I'm going to have to go back on the transactions we closed last year and look them up. Send them your way.
Yeah. And the great thing, unlike a 1031, there's no tracing of funds. So in a 1031, as you know, you have to put that money with an accommodator. You could never touch the money. This, you could do anything you want with the money. And you could even go borrow the funds to invest in the Oz fund. You still get the deferral.
Amazing.
So maybe if I could just take a minute to expand on the pending Oz legislation. So this has been out there for at least 18 months, the Opportunity Zone Transparency, Extension, and Improvement Act. And so almost all of it's beneficial. So as I mentioned, there would be a 2-year extension of reporting the gain. It would get extended from 12/31/2026 to 2028. So 2 more years of an interest-free loan. And then the 5 and 10% basis increase, where you would take a 5 or 10% haircut on what you report on 12/31/28, as long as you hold that for 5 or 6 years. Now, actually, because the legislation stalled, we're beyond being able to hold it for 6 years, but they'll obviously adjust that. But the bottom line is, this could very well come back. It's a bipartisan bill. Everybody in the Oz industry feels that this is going to come back, but it's just a matter of when it's going to pass. There's a couple of negatives in it, but necessary cleanup, where there were some Oz census tracts, it's less than 5%, that were designated, and it was all within the rules. But some kind of wealthier census tracts were designated under some technicalities of the law, and those are going to get sunsetted. Now, if you've started a project already there, you're going to be grandfathered, but they're going to eliminate those and then bring in some new census tracts that will be available. So if this passes, you're going to see a whole nother influx into the Oz investments, just because this is going to really increase its attractiveness. The other thing, which was in the original bill, it was kind of baffling that it got stripped out, that they had some reporting requirements to gather, how many employees you have, kind of what projects you're doing. They stripped it out at the last minute. Again, as a practitioner in this area, it was kind of frustrating that they did. They're going to put that back in. It'll be a little extra work on the CPAs and the fund managers, but it's useful information so that we can see if the program worked in 10 years.
Right. So let's talk about the ideal Oz candidate. Now that you've described it, I'm sure that every person that's considering a sale of a business, they're excited about it, right? They're like, do I qualify? What do I need to do? So tell us about where it works and where it doesn't work.
Right. Well, obviously, Rick, your expertise, the company sale. So, this is what you work with all day. And so that person that may be sitting on the sidelines going, geez, I think I'm just going to keep running and operating my business and, generating ordinary income for the next 7 years. And then I'll pass it on to my kids, or if they're really old, and if I pass away, it'll get stepped up basis. But when you explain this to them, it takes the sting out of the transaction. And so company sale is probably what we see the most as the funds to invest in an Oz fund. Real estate gains are probably number two, and again, we maybe 10% of the Oz funds we've set up are people with the crazy residential market over the last decade. A lot of people have some very massive gains on their sales of homes in California and here. And so we're seeing, multi-million. I've had $20 million gain on personal residences go into Oz funds. Stock market gains, not seeing as many this year as prior years, but we had a whole lot of those in the early years. Artwork, collector cars, Bitcoin, oil properties. I mean, you name it, we've seen it. And so what I tell people, the perfect person or profile for a captive Oz fund where you're going to do the investment rather than putting the money with some third party is if you're a serial entrepreneur, which is kind of your bailiwick, Rick. And then secondly, if either you have some real estate development experience or friends and family have that experience. So if you have those relationships already, or you could even, back somebody with a good operating business idea, and that's where your money could go. These are, this is kind of our client base. It's made up of serial entrepreneurs, a lot of real estate developers. So this program kind of works perfectly for them. The other one that we run into a lot is somebody's in the middle of a 1031 transaction and they can't find a replacement property in time, or they can't reinvest all of it. And so we've salvaged bad 1031 transactions because there's a lot longer timeline, especially if it's on a K1 gain, to reinvest those funds. We generally want an investor that's relative, if they're younger and in good health, that's better. If I had a 75-year-old entrepreneur that sold his business, I might not have him go into it, even though his heirs would still get the Oz treatment if they hold it for the 10-year period. It just isn't always the best fact pattern. So those are where we sometimes will talk them out of doing it. But you do have to understand you're going to have to hold it for the full 10 years. But we have modeled it out. And even if you hold it for just for the deferral period, in about 90% of cases, you're much better off doing the Oz fund because of the compounding earnings you get during that deferral period.
Gotcha. So a 1031 rescue. I love it.
Yeah. But this is, I won't go into this, but if there is an installment sale, which is quite common in a business sale, as you know, each one of those installment payments will start a new 180-day period. And so, we have a lot of clients that are getting paid out 5-10 years. And so they'll have a longer period of time to reinvest. You'll have my slide deck so you can share with people, but this is kind of the timeline for reinvestments. The other thing is once you've set up the Oz fund, you have, at least 6 months, it could be 2 years or 18 months, 19 months to reinvest. But then, everybody's like, well, how quickly do I have to reinvest it into Oz property, either real estate or operating business? You have another 31 months from the time that you drop the money down into your qualified opportunity zone business. So it's basically 4 years to be able to figure out what your business plan is and to find appropriate reinvestment property. So it's,
wow.
It's really, really quite beneficial for people that don't want to rush into something.
A lot of the people that I work with, like, their business is the single largest financial transaction of their life when we sell it. As they say in Japan, this is their rice bowl, right? And they want to protect it. And so they want to be very careful. And I'm pleased to hear that they have up to 4 years to decide which investments. They don't need to rush into any, like in a 1031, what happens a lot of times is you have those requirements, those time requirements, and the clock's ticking to identify the new properties. And so I know those people feel rushed, sometimes even pushed into investments, which if they took extra time, they may not invest in. But that's not the case with this one, where you have up to 4 years to invest these funds. I love that.
Right. And then just to quickly compare your captive Oz fund versus public funds, the captive fund, you're in control, you have overall lower fees, and you exit when you want. You might decide not to hold it for the full 10 years. You might have an emergency. You might pull out a portion of it. If you invest in public funds, and there are some good ones, and, glad to share those with you or your listeners. But you're going to be giving away 20 to 30% minimum of that through their carried interest waterfall. You've got annual management fees, carried interest, transfer fees, and you really don't have any control over the exit. You could sell your piece, but selling the underlying, you might say, hey, we should sell this real estate because it's topped out. You don't have any control over that.
Gotcha.
So I know we're close to being out of time here, but just a couple of quick issues, where people get in trouble is these entities generally are set up as partnerships. We come in a lot to fix broken Oz funds, and you have to make sure that those are really partnerships, that you have a secondary partner in there. A lot of times we'll have people with single member LLCs, which are going to effectively get treated as corporations, which is not a good result. People don't elect correctly. And so this is a complex area. It's not for the faint of heart. And there's, even though your CPA may be great, this is a very specialized area, and we work well in the sandbox with other CPAs. We'll just review their returns before they're filed, but do get professional help if you go down this path.
So I think we're okay to take a little extra time on this, Blake. I want to bring up something that you spoke about, which I think is very, very important. And I see that. I'm a CPA also, right? And we were trained in accounting. However, a lot of times when a business owner sells, their CPA who does their tax returns and their accounting work, they don't see these strategies. This is a very specialized practice and is very narrow practice. And so your CPA, oftentimes they don't have clients who sell their business often. And so they're not familiar with this. I mean, last time I looked, the tax code was 100,000 pages long. It's huge. And so it's just too much to know. So I think it's critical for business owners to know when you're contemplating a sale, you absolutely have to get with someone like Blake and his firm who specializes in and deals with the sale of businesses every day. I mean, these things, this is practice and the tax code and what you need to know to do this. Oftentimes your CPA, even though they're great and you love them, but they're not going to know these things. They're not going to be aware of them just simply because they don't deal with it every day. And so you're definitely going to want to enlist the help of people like Blake and his firm, because Blake can run sophisticated financial modeling on these. They've got the software and they've got the ability to show you and help you make an informed decision. So I can't emphasize that enough. So many times I've seen people just throwing money away and tipping the government because a well-meaning CPA didn't know the tax law or didn't understand the different strategies out there for reducing the taxes. Oftentimes, sadly, I see people will go to their CPA and they're like, okay, tell me about some different strategies to minimize my taxes on the sale of my largest financial asset my whole life. They're like, here's their strategy, pay the tax. Right? In my mind, that's not a strategy.
Really? Right. No, and there's just a lot of bad information out there on this program where people just don't understand the extended time frame. They they'll tell their client, oh, you've missed the window, it's too late. I was on the phone with 4 private equity partners, had a very large gain in March, and they had been told by their CPAs that it was too late for them to set up, and it was a K1 gain. They have until 2024 to set it up. They were so relieved, and so we're going to set up 4 Oz funds for the different partners. But
wow, one other thing. Question for you. So with C Corps, when we're selling those, we see a lot of these old C Corps hanging out, from the 80s. Does it do anything about the double taxation? Can we help with that at all?
Well, I mean, the age-old problem, the buyer of a C Corp, doesn't want to buy the stock. They want to buy the assets. So if you could talk them into, and you might be able to compromise on the sale price in order to have them sell the stock rather than the assets. And then you would avoid the double taxation. But even if you sell the assets, it certainly does mitigate, because again, if you are getting a 4-year interest-free loan and then your reinvestment is getting tax-free treatment, if you look at the overall tax burden, on all pieces of that, you're definitely look out of the double taxation, even if you had an asset sale. There's definitely benefit of the Oz program, whether it's selling a C Corp or a S Corp or some other flow through entity.
Got it.
And as I mentioned, I have my own Oz fund where we convert shipping containers into housing, and so we have both the real estate. We own the commercial real estate as well as we have the operating business. So, and this is one technique that I and a couple of attorneys developed early on is you can set this up so you can have 1202 treatment on the operating business. That's why we split them up into 2 separate businesses. And you could actually exit the operating business within 5 years, even though it was under the Oz structure, and get your up to $10 million gain or 10 times the larger of 10 times your basis that you invested in that, and then hold the real estate for the full 10 years. So it gives you, more flexibility on an exit, and you don't have to wait the full 10 years on the operating business.
Love it. And you talked about Section 1202. That's something that some people may not be familiar with, but that's another, if you qualify and it's structured properly, another way to eliminate or defer the taxes. That's like an added layer. That's not the cherry on the top. That's like the frosting and another cake on the top of the cake. I love it. Like,
right. 1202 is another, highly specialized area that we, often will get in after the fact. Somebody's sold, and then it's like, we start looking at the facts. It's like, you're 1202 eligible potentially, but there's a lot of ways you can blow 1202 also.
Oh yeah. Yeah. I tell people if they have one of those old C Corps, see if you qualify. You're one of the lucky. I tell them it's like hitting the lotto to be able to qualify. That's terrific. So you've given us a lot of great information today. Thank you. But I want you to share. In fact, I'll go ahead and read it. It's on the screen here. So Blake Christian, and his email is Blake, BLAKE .Christian, CHRISTIAN @ and there are 4 letters. H is in Henry, C is in Candy, V is in Victor, T is in Tango, HCVT.com. And that's how you reach Blake, or you can call his firm directly at 435-200-9262, 435-200-9262. Thank you so much for joining us today, Blake. Did you have anything else that you wanted to share before we end the podcast today?
No, I just really appreciate all that you do, Rick, and your expertise on company sales. And, I know we'll be continuing to work together, and any questions I can answer for any of your listeners, glad to do it.
Sounds terrific. Thanks again, Blake. And thanks everyone for attending our podcast, Murders and Accusations, the good, the bad, and the ugly of selling your business. And today, it's the good of selling your business, tax savings. Have a great day, Blake, and thank you for tuning in, everyone. Bye now.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.